All right, let's jump right into this explainer. Today, we're putting iRhythm Technologies through the ultimate ringer, Warren Buffett's rigorous 5-step value investing framework. Now, if you've been following the medtech space at all, you already know iRhythm is making absolute waves with its Zio patch monitors. They're a true leader in AI-enabled cardiac monitoring. But, as value investors, we don't just buy a great product, we buy a business at a price that actually makes sense. So today, we're going to act as your very own value investment committee. We'll pull the raw data directly from their Q1 2026 earnings filings and recent industry reports, and we'll see if this high-growth stock really holds up to classic value principles.
So here's the game plan. We'll walk sequentially through the business and its economic moat, do a deep dive into the financials, run the valuation models, check for a true margin of safety, and finally deliver our ultimate Buffett-style verdict.
Step 1. Understanding the business and its economic moat. To put it simply, iRhythm provides those wearable ambulatory cardiac monitors you've probably seen, called Zio, which detect arrhythmias like atrial fibrillation. Patients just wear these small patches for up to 14 days, the data gets uploaded, it's analyzed by proprietary AI, and then reviewed by technicians to give doctors a solid diagnosis. But honestly, the real key to this business model is how they protect it from competitors. Buffett demands a durable competitive advantage. So, does iRhythm actually have one?
When we look at the hard data, we've got to rate their economic moat as narrow to wide. And here's the evidence, straight from their latest earnings call. First off, they possess an incredible network effect fueled by over 3 billion hours of curated ECG data. Literally every single new patient makes their predictive AI that much smarter. Second, and this is absolutely crucial for their moat, they have massive switching costs. Right now, 53% of their total volume flows through accounts that are completely integrated into the hospital's electronic health records, or EHR. In fact, over 75% of their top 100 customers are deeply integrated. Once a hospital goes through the trouble of embedding Zio into its digital workflow, ripping it out for a competitor, that becomes incredibly painful. This moat protects a dominant 72% market share in long-term cardiac monitoring.
Now, you can't assess a moat without looking at the people digging it, right? Management quality and candor are absolutely vital. Are they being straight with shareholders? Well, when evaluating this, we have to weigh their optimistic bump in full-year revenue guidance, which they just raised to a midpoint of $880 million, against their totally frank acknowledgement of some serious regulatory headwinds. CEO Quentin Blackford openly discussed the ongoing FDA warning letter and a DOJ civil investigative demand regarding their Zio AT product. They aren't trying to hide it. They've hired third-party reviewers who actually found no material issues in their quality management system. Honestly, that level of transparency earns them major points on the Buffett checklist. Moving right along to Step 2, deep financial statement analysis. And wow, Q1 2026 reveals a pretty brilliant dynamic. Top-line revenues surged by 25.7% year-over-year to $199.4 million. But here's the real kicker. Notice the dynamic between revenue and expenses. Operating expenses only increased by 9.3%. Because top-line revenue is significantly outpacing those expenses, they are demonstrating fantastic operating leverage. Gross margins expanded by over 2 percentage points to nearly 71%, and adjusted EBITDA swung from a loss to a positive $14.1 million. The GAAP net loss essentially got slashed in half. You can clearly see this business is rapidly scaling towards profitability.
Now, I've got to be totally upfront with you as an analyst. Because we're relying purely on recent Q1 filings for this explainer, we hit a bit of a roadblock with our source data. We're actually missing the multi-year historical cash flow, total long-term debt, and equity figures that you'd normally need to perfectly calculate Buffett metrics like consistent return on equity, return on invested capital, and exact owner earnings. So to bridge that gap, we have to use some conservative assumptions to model their intrinsic value, leaning pretty heavily on management's path to profitability and their $885 million top-end revenue guidance.
For instance, check out this Q1 free cash flow, negative $33 million. I know, at first glance, a value investor might completely balk at that, but hold on, we really shouldn't panic. Management clearly attributes this to expected seasonal working capital and annual compensation payments that are just typical for the first quarter. More importantly, their balance sheet is an absolute fortress. They're sitting on $549.6 million in cash and equivalents. That provides substantial liquidity to weather those regulatory storms and fund their future next-gen mobile cardiac telemetry, or MCT launches, without needing to immediately dilute shareholders. Okay, let's shift gears to Step 3, our valuation models. Since we don't have perfect historical free cash flow, we project forward using 3 distinctive discounted cash flow scenarios. We assume a standard 10% weighted average cost of capital, or WACC, and a 2.5% perpetual terminal growth rate. First, our base case projects cash flows grounded in their stated 17 to 18% revenue growth and expected operational efficiency gains. On the flip side, the optimistic scenario heavily factors in their upcoming next-gen AI algorithm. Management stated this tech could cut technician review time by 50% over the next few years, creating well over $100 million in cumulative value. And conversely, the pessimistic scenario actively prices in severe delays stemming from those FDA and DOJ issues.
But when we try to run this through the classic Benjamin Graham intrinsic value formula, we literally hit a mathematical brick wall. The formula relies heavily on earnings per share, right? Well, right now, iRhythm's GAAP EPS is negative 43 cents for the quarter. Even if we estimate a 7 to 10-year forward growth rate and assume a standard 5% AAA corporate bond yield, since that's missing from the filings, the formula completely breaks down. A negative input yields a negative intrinsic value. It just brilliantly illustrates how traditional deep value formulas really struggle to properly evaluate modern unprofitable growth stocks.
And it's a very similar story with multiple comparisons. Since there's no positive net income, a traditional PE ratio is out the window. There's no dividend either, so scratch the dividend discount model. This means we've got to judge their relative cheapness based on top-line revenue multiples, like enterprise value to sales. While gross margins are certainly improving, make no mistake, we're still paying a premium for a company that isn't quite yet generating consistent bottom-line GAAP profits.
So the real million-dollar question here is calculating the exact growth rate embedded in the current stock price. Based on our source data, the current market price sits at $120.66. When we run a reverse DCF, basically working backward from that $120 price tag to see exactly what kind of cash flows are required to justify it, we find that the market is already pricing in years of sustained, double-digit, highly profitable growth. The market expects absolutely flawless execution on their 2027 MCT device launch and perfect integration of those cost-saving AI algorithms.
Which brings us perfectly to step 4, calculating the margin of safety. This is literally the cornerstone of Buffett's philosophy, protecting your downside. To do that, we absolutely have to demand a 25% to 30% discount below our intrinsic value estimate before we'd initiate a position. Given the unresolved DOJ investigation and the FDA warning letter, the risk profile here is definitely elevated. A strict value investor requires a much wider margin of safety to directly compensate for those specific, unquantifiable regulatory risks.
All right, bringing it all together for our final Buffett-style verdict. Would Warren Buffett buy this company today? The answer is a very firm hold. Now, don't get me wrong, iRhythm is a wonderful business. It possesses a durable, moat-protected franchise with a 72% market share, improving operating leverage, and some game-changing AI on the horizon. It has honest management and a massive addressable market as care shifts more towards primary care and home settings. However, at $120.66, it is a wonderful business priced for absolute perfection. The current price simply doesn't offer the necessary 25% to 30% margin of safety to offset the uncompensated regulatory risks currently hanging over the stock.
I'm going to leave you with one final thought to chew on. You know, the value investing framework forces us to be super disciplined, but that doesn't mean we just walk away and stop watching. As iRhythm preps to roll out that next-generation AI algorithm, the one that could literally cut their technician review costs in half and dramatically accelerate their path to robust free cash flow generation, will that surge in future profitability eventually be enough to make today's price look like an absolute steal? Keep a very close eye on those margins in the coming quarters. Thanks so much for joining this explainer, and keep learning.